Are you like most sales and other professionals who want to grow their wealth faster than what they are currently doing through their company 401k, even with that company match, the stock market, or just plain saving money? Would you sleep better at night if you had the financial freedom to be job optional in just 3 to 5 years through investing in real assets? Maybe you don't want to stop working, but wouldn't it be cool if you could retire a decade earlier than most? And do the traveling you and your family have planned for years while you're still young and can enjoy it? Let's face it, most busy professionals don't have the time or desire to take on more work outside of their W-2 to grow their wealth. On The Wealth Flow, each week we share the stories, the investments, and take a deep dive into the various asset classes that can deliver that accelerated growth to your portfolio passively. That's right. No extra work for you. Instead, we'll put your money to work. Learn what the 95% aren't talking about and join the top 5% of earners today on The Wealth Flow.
All right, welcome to The Wealth Flow. My guest today is Chad Griffiths. Chad has worked in the industrial real estate industry since 2005. He's a member of a global commercial real estate company and a partner with his local firm. Chad has completed over 500 deals with clients ranging from small companies to large institutional owners, and has also built a sizable portfolio himself since 2014. In addition to being the host of the Industrial Real Estate Show, Chad is honored to have been the guest on over 30, we'll make it 31 now, real estate podcasts, as being interviewed numerous times by national media. Chad earned both his SIOR and his CCIM designation and an MBA, and is proud to have recently been named an industrial influencer by globestreet.com. Chad, welcome to the show.
Yeah, thanks so much for having me on. It's an honor to talk to a fellow podcaster and anything to do with industrial real estate.
There you go. I got a lot. You're my first on really on industrial. I had somebody on just recorded one recently, and they're starting to do some industrial, but really interested to find out about this particular asset class and kind of what you like about it. Before we get into that, though, if maybe you could just let us know, kind of how you got into real estate.
I would say I got into real estate the way a lot of people do in a general sense. I got in flipping houses. A couple of friends of mine and I, when I was younger, bought and sold houses and renovated them. And I had the itch to keep doing real estate, but wasn't having a whole lot of success on the flipping side. So as one does, I got my real estate license and I started in residential brokerage. This goes back to 2004. I did it for a year and just didn't see that being a long-term career for me. So I reached out to a few people that I knew and wanted to get into commercial real estate. And at the time, I thought I'd be working in office buildings or shopping malls, kind of that more glamorous or familiar side of commercial real estate. And it just so happened that the office that I joined was heavily focused on industrial real estate. So I completely stumbled into it. I knew virtually nothing about industrial when I first started. And it was drinking through a fire hose, trying to get up to speed on just a new business, being in commercial real estate versus residential, but also just figuring out how the industry works, what industrial is, what are some of the demand drivers, what do tenants look for. And fast forward, as I had in my bio there, started buying properties in 2014 with one partner, and we've expanded that. We've brought in a few more partners on a pure JV basis. So I've got the majority of my net worth directly invested in industrial real estate. So I kind of think that I live, breathe, sleep industrial real estate because I work in it full time and I've got so many of my eggs in that one single basket. So needless to say, I'm a huge industrial real estate nerd / enthusiast.
Right. Okay. And in what part of the country are you in?
I'm actually based in Western Canada, but incidentally, I've been following the U.S. market pretty closely as I've kind of tapped out how much exposure I want in my specific town. So I've been looking at Texas, probably the most lately. I've identified a couple properties that I'm interested in, and I've been following Florida and the Carolinas as well. So that'd probably be my order in how I'd want to invest in the U.S. right now. Access to a port market. That's why I like Texas with Houston and Corpus Christi right there. I like Florida. Basically my thesis on investing is follow the population growth. So that's the underlying assumption on where I'm going to identify markets at a high area first. And for those reasons, I think Texas, Florida, and the Carolinas are looking pretty good right now.
Yeah, for sure. And as far as industrial, when I think of industrial, obviously industrial is an asset class, but there's so much in it within that. You want to maybe explain some of the nuances and the differences between what type you either invest in or also help, clients with their purchase on.
Yeah, it's great that you brought that up because you're right. Industrial real estate is a fairly broad category, but there's a lot of nuances and differences between the subcategories. So I usually break industrial into warehousing, manufacturing, and flex property. Those are the three sub-broad categories, and then there's still other ones within there. But generally speaking, the vast majority of properties that I see are one of those three categories. So warehousing is the one that people have become much more familiar with over the last 10, 20 years as big Amazon distribution centers have popped up all over. You probably see a FedEx building or some sort of distribution center off the main road, perhaps by an airport. These buildings are basically where things are stored. So the items can come in for a few minutes. They can literally come in, get repackaged and sent right back out the door, or the items can stay there for several months, perhaps even several years. But basically where things are stored for some period of time. Manufacturing, the next major one would be buildings where things are made. And perfect example I like to give is the Boeing factory just outside of Everett in Seattle, just outside of Seattle in Everett, I should say. It's a 4 million square foot building, biggest building in the world by volume because it has 90-foot ceilings. But the whole idea of that building is all the raw materials come in, gets assembled, produced, manufactured, ultimately gets built into an airplane, and then the end airplane gets delivered out. It's a manufacturing building, and there's all types. There's from 4 million square feet like the Boeing factory all the way down to a 2,000 square foot little industrial condo. It's basically where things are made. And then the third category is sort of a catch-all. Flex industrial is often what it's called. And those are all the buildings zoned industrial. So the municipality will say this building is going to be used for industrial purposes, but quite often it's used for purposes other than manufacturing and warehousing. And one property that I own is a great example of flex building. So it's in an industrial park, but it's on a major road. So it has sort of a quasi-retail exposure to it. So we have an office tenant in there. One tenant's just a straight office. We have a hot tub manufacturer in there. We have a flower store. We have an equestrian retail store. And we just put in a furniture store, which is going to have some showroom and a little bit of warehouse in the back. So that's a pretty good example of a flex building where almost any conceivable use could probably fit somewhere in a flex industrial building. But there's wide range going all the way from a small company that might manufacture little trinkets all the way to massive companies that either manufacture or warehouse items. There's everything in between.
Okay. Wow. That's interesting. And if it's zoned, are there different levels of zoning when it comes to industrial, or what does that look like? Reason I'm asking, I'm just thinking, there's sometimes when I think industrial, I also think like, I don't know, gasoline or some kind of, or maybe chemicals then in the manufacturing process that maybe, you wouldn't necessarily want to have right next door to you. Are there different classes of zoning when it comes to that, or?
Yeah, great question. And it varies from municipality to municipality. There's not a uniform zoning code that's going to apply across every market, but there's a lot of overlap and a lot of similarities. So the three most common ones that I'd see would be light industrial, probably some kind of business industrial, and then you'll see a heavy industrial. And there you might see a medium industrial, or either little nuances in there, but it's generally going to be light, heavy, or business. And the business industrial, that's where you probably would see a gas station. The building that we have with those various different uses in there, that's a business industrial, because they're not necessarily industrial tenants. So a hot tub or a flower shop actually is a good example. A flower shop is not an industrial tenant whatsoever, but they can fit into a lot of these buildings, and the building actually works quite well for them. So those buildings, typically you'll see like a business industrial, and then the heavy industrial is going to be reserved for, like you said, like those chemical uses or the heavy manufacturing. And if you really look at how zoning, why there is zoning, it's so that municipalities have the discretion on where they're going to put these uses. Because for the most part, you don't want to have a heavy manufacturing facility right next to a school, or you might not want to have a heavy manufacturing facility right next to a big residential neighborhood. So the city uses these levers so that they can control essentially where these are going to go, so they can put the heavy manufacturing out of the way, out of the public purview, away from some of those more sensitive areas, whereas they might want to allow a building on a main road that has good curb appeal and it looks nice. They might want to allow that to have more uses that could open up to the community or other businesses in the area. So that's why the city, any city, will really want to have those controls in place. But that's typically what you'll see. Like a light would be a warehousing. So Amazon, for example, it's pretty clean. Trucks come in, they drop off boxes, the boxes go right back out. There'll typically be some sort of light manufacturing business where you could have any number of uses, and then heavy industrial. But again, it does vary city to city, so people should familiarize themselves with their own local zoning ordinances. Yeah, it's really interesting. So I have invested in residential buying and selling, and at one point I owned a fourplex, so not really on the multifamily scale of some of like the 50-unit building, but I've got a little bit of experience in it. And what I liked immediately about industrial is there's a few things. One, you're leasing to companies. So instead of being beholden to residential tenancy acts where they're typically favoring the tenant much more than the landlord, on the industrial side, it's pretty much just following contract law. So provided the two parties agree on something, that's what enforces the agreement. So you don't have to necessarily worry about kicking out a family if they're not paying their rent, which I would find very hard to do. It's a corporation. So not only are you dealing with a company from the sense that you don't have that emotional tie to renting to a family, but you also get to see their financial statements. So you can look through what's their revenue? How much have they been spending on their rent? Are they able to afford their rent? Do they have retained earnings? There's a few things you can really dive into to get a sense of comfort on these. And then because they're corporations, they tend to be longer leases. So whereas a multifamily property, you might do a 6-month or a 1-year lease and try to renew those. I've done 10-year leases, and I've worked for clients that have done 15, 20-year leases. So you get a corporation that you're leasing to for a long period of time. They're typically triple net leases, meaning that you charge a base rent to the tenant, and then they're also responsible for paying their proportionate share of all the operating level expenses. So if there's any increases in taxes, that gets flowed through to them. Any increase in property insurance, that gets flowed through to them. So you're not eroding your profit level by having an increase in any one of those expenses. That's a very simplified way of describing a triple net lease if people aren't familiar. You need to check the language in your lease to make sure that that's how it's written, but 99% of all leases I've seen are triple net leases that way. So if from the context of a multifamily property where you're renting out to individuals or families, you rent it out to corporations, you're doing it on a long-term lease. Your lease should be structured such that you can pass any increases in expenses directly through to them. And the last thing, what I like about it is you have the ability to scale easier. So one property that I own as an example, I have a single tenant in there. It's a Fortune 1000 company, very large company on a long-term lease. I haven't been to that property in probably 2 years now because they take care of everything. The light goes out, they just deal with it. They're not going to bother me to do do it because I'd charge them a management fee anyways to do it. So it's much easier for them to do one tenant. It's about a $3 million building. Compare that to a multifamily property where a $3 million building might get you 20 units, 15 units. I have one commercial tenant in there that does everything on their own and never have to even deal with it, compared to all the management challenges that would come with having 15 tenants and all the issues that come up and all the rollover that comes up. It starts making it seem like you can scale that much easier industrial as opposed to adding another 15 unit multifamily building. Me adding another building like this is much easier in comparison. So those would be the main reasons why I've been attracted to it. But that's not to say multifamily isn't good. I've studied this actually pretty extensively because I've had investors ask this question. I think the returns are actually fairly similar over a long holding period. But there's just those intangibles about corporation, longer term leases, less turnover, easier use of management. I think that's what's been more appealing to me.
Yeah. Okay. Very interesting. And with the ones that you've invested in personally, tell us a little bit maybe about your first industrial. I'm assuming it's after you've spent a little bit of time, selling and listing them for other people. But what did you start with?
Yeah, and that's very interesting too, because a lot of people think with industrial is that it's these large assets, these big assets, like me saying the $3 million one as an example. The first one that I bought was a $400,000 industrial condo. It was a 2,000 square foot condo. Now I bought that in 2014. So by that point, I was 9 years in the business already. And there's a couple reasons why it took me that long. Is one, I wanted to just make sure that I knew exactly what I was getting because I'm putting my own money into it. I'm not syndicating these deals. It's my own capital going into it. So I wanted to make sure that I was comfortable with it. But I also needed just to get to a position where I could put the money down. So you have a family, buying a house, buying cars, putting your kids through school and through sports. It's just took that long before I was in a position to comfortably put that money out there. So 2,000 square foot condo. I had a tenant in there. It was a kitchen equipment supply company. So they basically just serviced restaurant kitchen equipment, and it was full to the rafters. But we had them in there for 5 full years. When they said that they were closing their business down, leased it within a month. Now we have a machine shop. I still own that bay actually. I've bought and sold a couple other condos in that time, but I still have that bay. That's just kind of a sentimental key one for me, just because it kickstarted the whole journey. But it was shortly after that we started scaling, going after larger properties. But the industrial real estate can be very attractive for someone that at $400,000 is the price of a house. So if somebody did want to get into it, they shouldn't necessarily be scared off on how large it is. But it's also could bring up a pretty good point that as much as I am pro-industrial and as much as I sing the praises of it, I also caution people that rushing into industrial can be very devastating. So is it okay with you if I maybe go through some of the reasons why on that?
Yeah, for sure. Please do.
So I love industrial, and it's probably apparent just by how enthusiastic I talk about it. But I've actually said to people before that industrial should actually scare people. It should be an asset class that they are inherently scared of, because having a healthy amount of fear will help eliminate the potential of making a huge mistake. And it's difficult to make mistakes in multifamily. Like if you have an appraisal done on the property and you do all the inspections and the bank underwrites it and everything looks normal and there's nothing about the property that is outside of the normal for the market. So we'll call it, if it's all 2 bedrooms, you buy a 15-unit building with all 2 bedrooms, and it's all 2 bedrooms in the area, and you're confident that the rents are sustainable, you don't have a whole lot of risk there. Like you could buy that property, you might not have a ton of upside, but you don't necessarily have a ton of downside either. With industrial, you can have that same commensurate amount of upside, but you can have virtually unlimited downside. But there's the risk, and I'll give an example. So one property in my market used to be run as a glass manufacturing facility, so it was very customized. And as you can appreciate, there's a lot of things that go into making fiberglass and it required a heavily customized building. When the glass manufacturer left, it required, if memory serves, somewhere over $1 million worth of work to retrofit that building to make it leasable for the next group of tenants that went in there. So it went from being a single lease to that glass manufacturer. Landlord put in over $1 million and then ended up leasing it to 3 different tenants. But how many people are in a position where they buy a building, and let's just run through this scenario. Let's say that before that glass manufacturer left, the owner sold the building, and he might have sold it along the premise of saying customized building, custom built for the tenant that's in there. Tenant has been in there for 35 years, once in a lifetime opportunity, however much conjecture they want to put in there. And an investor came along and said, oh, this looks great. Here's a building that was specifically built for these guys. They've been in there for a long time. We're going to go buy the building. 3 years later, or whatever amount of time comes later, the tenant announces that they're going to leave. And it's going to cost $1 million to retrofit that building. How many investors are in a position to go and spend that much money to rectify it? So I always caution people that I love industrial, but I've spent 18 years in this business now, and I spent 9 years being a broker, working in it every single day before I was in a position to invest in it myself. So I say that there are cautionary tales like that, and that doesn't happen all the time. In fact, most of the time, you are able to find a tenant and release it relatively easy with some minor capex. But there is that risk that if someone's not paying attention, and it's usually in the form of dumb money, right? Someone just rushes in, they see an opportunity to buy something, they don't look at the whole picture. Those are the ones that usually make the most mistakes or the worst mistakes. So I always just caution, have a healthy amount of fear going in and really commit to understanding exactly what the market is, what industrial real estate is, what are some of the pitfalls, what are some of the things that they should really watch for, and make sure that they're an expert in that local market before they invest a dollar. Otherwise, there is the chance that that downside risk greatly exceeds what they're comfortable with.
Yeah, that would be huge to have $1 million expense just to be able to release it. That's a great point. What about on as far as so your first purchase, at least as far as your own investments, was this warehouse space. What was the next? Where'd you go from that one, the $400,000 one, to kind of, if you could give me an idea as to what happened after that?
Yeah, the next one was another condo, and it starts getting a little convoluted, which is the way that my whole ownership structure has evolved. But the next one we did, so the first one we actually did a vendor take back. So the owner owned that one free and clear. So we did a 3-year term of him providing financing. I don't remember the numbers exactly, but it's something like we put down $100,000 and he carried $300,000 for us, give or take. And we found another condo the next year. Our goal all along was to try to add one property a year. So we found another condo, and then we ended up doing a blanket mortgage. So we had a lender basically provide us one mortgage on both properties so that we could take out the VTB and have that one mortgage covering both properties. So that was the start of us thinking that we were these real estate tycoons who can do sophisticated financial instruments like that, when really it just turned out to be a mess because we sold the second one shortly thereafter. We had to break up the blanket mortgage, and then it actually just turned out to be a mess. But it was shortly after that we just started chasing bigger properties. And it was partly a reflection that we had, my main partner and I, we just had more capital as we were making more money in brokerage. So we had more of our own money to deploy, and we just started getting comfortable with it. We just, so that we started in 2014, the industrial market started picking up steam right along that point. So we saw an opportunity of it becoming more prevalent, a lot more people interested in industrial real estate with the shift of e-commerce and just the way the public mindset was, or at least the business mindset was changing towards industrial. We just thought it'd be a great opportunity to scale. So the next one, I think there might have been one smaller one in there too, but the next major one that we bought, or the first major one that we bought, was roughly a $2.2 million building, multi-tenant building, where we brought in some more partners on that one. So we expanded our JV scale and just brought in some more capital. And that's pretty much been the preference since, is we like getting tenants with either really strong tenant in there, like the one where we have that large company in there, or getting multi-tenant where we can diversify the risk over multiple tenants within the building.
Yeah, I think that that would make sense, but I guess, depending on the company, as long as it's a single tenant that you've been able to screen and seen that they're, financial, they're financially sound, and then betting on one is I guess acceptable in that stance. But it's one of the things I like about, whether it be multifamily, whether it be whatever, with having multiple potential tenants. If one goes down, it's not devastating, but I can see how it could be with especially an expensive, asset to have just, their business fail or whatever. So.
It's a very fair criticism of industrial, and it's another reason why people need to be cautious going into it. Is you're right. If that one tenant were to either not renew their lease when they came up or defaulted, which happens all the time, companies go out of business. Even though this one's a particularly large company, it is a possibility. And in that event, we would lose 100% of our income, plus would be responsible for all the operating level expenses on top of it. So it'd really be a double hit by losing that one tenant. And I do agree. I think that from a peace of mind standpoint, having multiple tenants and diversifying that chance of that happening over dozens of tenants is key. I suppose to some extent I offset that risk by the fact that if the tenant did leave, well, now we have an asset that we might be able to sell to an owner user. So it's now a vacant property. There might be a company out there that wants to buy it. Companies generally will pay more for an owner user than an investor will. So there could be an extra opportunity to dispose of that. And I also just think, knowing that market so well and being immersed in it day to day as I am, I think and I feel confident that I would have as good of a chance of releasing that as anybody else in the market would. But again, that's an advantage that I have that a first-time investor doesn't have. So it really is key that industrial is great. It's a great investment vehicle, and it can be a very viable way for people to diversify or just change it up if they're sick of dealing with residential tenants. But it takes a tremendous amount of commitment and time to make an educated decision versus being that quick, dumb money.
Yeah. And on the multi-tenant one, that was the first really large purchase. Was that a setup very similar to like the condo deal, as far as being multiple tenants over one large building that's got walls in between separating it, or what does that look like?
Yeah, exactly. So the first one we bought was, and the terminology can vary on this too. Like I've heard them called stratas before, but it's essentially imagine one large building where it's all split up with walls, but within each of those independent units, there's a separate legal ownership that goes to them. So that's the condominium model, very similar to residential in that regard.
Gotcha.
So the first one that we bought was just one industrial condo. So I think the whole building was 40,000 square feet. Ours was a 2,000 square foot condo right in the middle. So we had legal ownership of just that one unit. The larger one that we bought, very similar in terms of it being a large building like that. Just that one only had one legal title for the whole building. So we bought the whole building versus just one unit in there. But the building itself, a tenant going into there would have no idea whether that's a condominium or whether it's the whole building. They just know that they're leasing that space from the landlord. So from the street, the average person would have no idea how that they're actually broken down from a legal standpoint, because at the end of the day, it's just the tenant wants to lease a space. However it's suited, if it works for them, it's going to work for them. The legal structure is generally not something they're concerned with.
Yeah. Okay. And then what about so if you were going to and you got a great perspective because you're actively helping people buy and sell these. If you were to get a phone call and it was the kind of the dream listing of one that you just know, whether you buy it yourself or just that you could basically unloaded pretty quick on the market. What is selling fast right now that would be very appealing to be able to list?
Yeah, there's completely different levels too, because if there was a building that came up that had Amazon as a tenant and FedEx as a tenant and another large distributor, it could be $100 million building that would be a dream to list. There will be a buyer that buys that property just because of the security of those tenants that are in there. So that would certainly be one. For myself, I really like the flex industrial model. The warehousing, for the most part, is just outside of my capabilities. I can't go and buy $100 million building. I just don't have the resources without doing a considerable amount of fundraising and exploring different ownership models that I haven't done yet. So that's just out of my wheelhouse. So that'd be a great opportunity to list and to market, but just out of my wheelhouse personally. I like that flex property within the $3 to $6 million range. That's something that's if you've got a good system in place and a good track record, there's financing all the time for that. You can put so many different types of tenants in there that I've got a reasonable degree of comfort that there'll always be tenants in there. And incidentally, even our portfolio right now, and I think at last check, we were at 28 tenants within all of them right now. We don't have a single vacancy. There might be one really small office space on the second floor of one of our buildings that's empty. But aside from that, we're full. We have 100% occupancy in our portfolio. And even through the pandemic, even when it was really bad, the first 3 months when we weren't sure what was going to happen, we had to defer rent for 2 of our tenants, and they caught it up shortly thereafter, and we didn't have a single missed payment. So I think that that flex industrial, if it's managed responsibly and proactively, that's very attractive to me. So I would say something in that $3 to $6 million range would be appealing. But anything industrial right now, even though the market has some pressure on it as a whole, it's in many markets, Los Angeles, Vancouver, Toronto, New York, New Jersey, they're all sub 2% vacancy rates. So there's so much more demand than there is supply that listing anything right now is never a bad strategy.
Yeah, for sure. And as far as finding tenants on it, are you just putting these out on commercial MLSs, or what is how do you find, or you have network that you work with, if it's a specific type of property that maybe you've leased to some companies in the past that they've always got an additional need, or how are you going about filling these?
Yeah, sometimes it's all of the above. Sometimes it's one of the above. I like to market as aggressively as I can from my own properties that I have or that I list. So I want as many possible people to know about the opportunity as possible, just from the standpoint that you never really know if you're getting the best tenant on the best terms at the best price unless everybody knows about it. But there are scenarios where it has to be more discreet. It can be a building where a property owner wants to sell, but he doesn't want to alert all the tenants in there that he's selling. It can be that a property owner doesn't want to market a property with a certain lease rate because he doesn't want other tenants to find out and have that influence future negotiations. So there's all sorts of circumstances where it can be a full-on press, try to get everybody you possibly can, cold calling, door knocking, circulating to all the other brokerages, open houses, all sorts of things we've done. But sometimes you have to be very undercover with it, and that you do take out to a few select people, and you're almost trying to avoid marketing it, either out of fear of upsetting tenants in there or altering how one of the tenants might negotiate in the future. So it's the full range. It varies property to property.
Wow. Okay. Yeah, that's interesting for sure. And as far as beyond the warehouse type, you said flex spaces is another one that you are interested in, or that you'd be purchasing on those. I guess what's the next? What's kind of your buy box look like? Is it just the $3 to $5 million flex space, or is there something specifically that you're looking for right now?
Yeah, and this is another one where it can be on a full spectrum as well. Like on one end, you could find a building that's vacant that doesn't have any money, any rent coming in, all the way to finding a building that has a 15-year tenant with a AAA company like FedEx. So there's the value add being like an empty building where you've got to try and figure out how you add value to that building, all the way to one where you know exactly what your income is going to be for a long period of time. I'm in the middle. I don't have the appetite for that much risk of buying a vacant building and waiting for the tenant to come in. But I also have some amount of appetite where if there's a lease coming up in 2 years, that gives me a pretty long runway to find another tenant or negotiate with that tenant to try and get them to stay. So I'm somewhere in the middle. I like having cash flow right from day one. Just cash flow solves so many problems, and having an empty building, while it has higher upside potential if you hit a home run, it also just comes with a corresponding amount of risk. So I kind of always looked at risk and return on a pendulum basis. So if the pendulum has a potential of swinging 30% to the downside, it really should have a 30% upside, in my mind at least. Whether it makes sense, this is just how I choose to frame it. No. So the ones that I look for, I'm probably looking for, like on an adjusted IRR basis, call it a 15% upside, a 15% return annualized over the holding period. And I expected there to be a corresponding amount of downside. What I think is the worst thing someone can do is take on a property with 30-40% risk and only realize a 5 or 10% return. That to me just doesn't make any sense at all, using the pendulum analogy again. So I don't have the appetite to swing 30-40% risks and realize those. I'm using another sports analogy. I'm a baseball player who just likes hitting singles and doubles. Maybe one day you do swing the bat a little harder than you thought and you do hit a home run or you strike out. But if you're consistently hitting singles and doubles, you still get runs in at the end of the day.
Yeah, for sure. And so how many properties do you currently have in your portfolio?
We're at 7 now. We just closed on the 7th one in December, I guess, which is crazy. We're 7 months from that already. It feels like it was just yesterday, but yeah, just the late 2022, we closed on that one.
Okay. And what are you seeing as far as how much debt are you typically putting on these? How much down? And are you using local banks, or are there national lenders that you tend to use? What does that look like?
Yeah, we typically put down at least 30%. In some cases, it's been higher, although in one property, we were able to do lower than that. But for the most part, we're at least 30%. 30 to 35% would be common. And I'm agnostic when it comes to who the lender is. I just want to get money on the best terms that I can. So if that's a local lender or a community lender or state or provincial wide lender or national, that makes really no difference to me as long as the terms and rate are competitive. I couldn't care less who lends.
Okay, fantastic. And as far as what are some other things that we should know about the industrial? As far as, I don't know, maybe time to close, how long does it take for an industrial deal to go through? Is it higher or take longer than normal commercial real estate, or is it pretty well in par with that?
No, that's a great point, and it is significantly longer both on the leasing and on the sales side. So I just wrapped up a lease. Friday is when we actually finally got the last signature on it. Another large company is the tenant, based in the U.S. with a very large market cap and a very large legal team and a local landlord in our market. And it was a 4-month process, start to finish. From the time that they identified that they actually wanted to be in that space, it was a 4-month process. There's a lot of layers of administration and checks and balances that go in, which is, I suppose, a trade-off versus dealing with an individual that just wants to rent an apartment. That can be a very quick turnaround process. Just how many layers were involved in this, that was a very long process. And on the sales side, it can be even longer. So in a best case scenario, I'll run down an example. If I found a property that I wanted to buy today, so I've just toured through it, I've identified that I want to buy it, and I put a purchase contract together, I might be a week to 2 weeks just negotiating that purchase contract, especially if lawyers get involved and there's more changes than I'd expect. A week to 2 weeks to get that negotiated. And then I'm anywhere from 6 to 8 weeks, in sometimes even further, to go through the due diligence and arrange financing. And the reason that takes so much longer is that a lender, they're basically underwriting the property for what happens worst case scenario. What happens if I default on my mortgage and they have to take that property back? Well, from a risk assessment standpoint, they want to make sure they're getting back a property that they fully understand. So I need to get 3 reports to essentially satisfy the bank's risk assessment on this. I need to get an environmental site assessment, which is where there's different phases for it. A phase 1 is basically an inspector will go out, they'll do a visual walkthrough of the property, they'll do a historical record search, basically identifying if there's any reason to believe that there's contamination. And if there's no red flags, they'll typically write a report saying no further testing is recommended. That's the best you're ever going to get on an environmental and an ESA phase 1. If there is reason to believe it. So perhaps in their historical record search, they found that there was an underground storage tank holding who knows what. Then they might say, well, we have reason to believe that there might be contamination. So then they recommend a phase 2. That's when they actually go and bore holes, physically test the soil in a lab, and determine if there's any trace elements that could be contamination. Then it gets even more messy if they do find something, because then you've got to go through a phase 3 to come up with a plan. Then you've got to get a phase 4 to make sure that it's all taken care of. And then you need a remediation certificate. That whole process becomes very messy. And I'm in with my clients and my own properties, I've never gone past the phase 2. If there is a phase 2 required, the time and money that's going to be involved in rectifying that can be in the hundreds of thousands, if not in the millions of dollars, and take years or years. So I've never gone through that route, although there are a lot of properties that do get remediated. I typically just want to see a phase 1 that says no further testing is recommended. But that takes time and money. So it's probably anywhere from a $2,000 to $4,000 cost, depending on where you are. And that'll take a month, generally speaking. Then you've got to get a commercial appraisal. Same thing. Could be $2,000 to $4,000, could take a month. Then you also need to get a building condition assessment, sometimes called a property condition report. Varies from market to market. But that's where someone's going out and checking all the major components of the building: roof, electrical, HVAC, plumbing, foundation, parking lot, everything in the building. And then they'll give an assessment on how long it's going to have for a lifespan, and then also what it's going to cost to fix when that's coming available. So those 3 reports together will give a bank pretty good peace of mind on exactly what they'd be getting if I defaulted on my mortgage. Building condition assessment, again, that could be $2,000 to $10,000, depending on how elaborate you go into it and how big the building is. So a potential buyer can be into this for, call it $5,000 to $15,000 before they've even committed to buying the property. Then if they want to have their lawyer involved, which they should be having a lawyer review all the contracts, whatever your legal expenses are, but you're a month minimum to get all those reports lined in, then the bank has to take those and synthesize them all, go through them, fully understand what they're getting, and simultaneously they're underwriting the buyer. So they're making sure that I have the ability to service this loan and everything that goes with it. So those 2 processes are happening simultaneously, and best case scenario, that's a 6-week process. Like that's optimal. Quite often it can be 8, 10, 12 weeks. If there's any wrinkles that come up with any of those reports, any wrinkles that come up with the buyer, I might have something on my finances that's an issue. It doesn't take much for those reports or the bank's approval to run longer than that. So that is something that people need to be prepared for. And that's another strike against industrial on why some people might just shy away from it versus a much easier to close residential investment or even a multifamily property.
Yeah. What about depreciation? And are you seeing any, like, do you guys do cost segregation studies or anything with respect to depreciating the property when it comes to industrial?
I will be when I buy the property in the U.S. I'll absolutely be doing cost seg. We don't have that option in Canada, so unfortunately not. We also don't have 1031 tax exchanges, so there's a lot more reasons to be So two more strikes against investing in Canada, anyways. And I think that's very beneficial for the U.S. market, because both of those things keep investors making a little bit of extra money in their pocket every year.
Okay. Sounds good. Well, yeah, hopefully you'll get some stuff here down here in Texas. I'm in San Antonio, so but
I like that market.
what about yeah, for sure. How if somebody is interested in utilizing either your brokerage service, or they just want to reach out to you, I guess another question would be, are you open to joint venturing with other folks? I know you've done it in the past with people. I don't know if those are just people that you know, or if somebody runs across a deal and needs some additional help in taking it down, or is that something that you're open to?
Absolutely. Yeah, I've actually looked at a few deals in other markets. I looked at one in Ohio not too long ago, where someone was looking for an extra partner in it. And I also looked at an area just outside of Chicago. I don't like either of those markets particularly well. The deals were both attractive from a paper standpoint. My thesis is pretty simple. I just want to go where population's going, and then start looking from there. So it'd be market specific, but absolutely, if someone has an opportunity, and especially Texas, that's probably my number one target right now, or Florida or the Carolinas, I'd be absolutely interested in talking further.
Perfect. Sounds good. Well, how can people find out more about you? Do you have any socials, anything that people can look you up on?
Yep. So like you, I've got a podcast as well, just called The Industrial Real Estate Show. So I bring on a variety of different guests, ranging from property owners, developers. I have a developer actually coming on the show tomorrow, who's a developer in Texas, actually, and he's going to walk through a $8 million development that he's working on. But lawyers, accountants, engineers, brokers, you name it, anything involving industrial real estate where I think it'd be of value to the audience, I try to bring on. So that's just on my YouTube channel, or it's on Spotify and Apple, iTunes, and all those as well. And then also active on Twitter. So either one of those would be great.
Okay, fantastic. I got two more questions for you, and then we'll call it a show, since we're getting
Awesome.
kind of to time here. As far as somebody being maybe just starting out in their investing career, what advice would you give somebody?
Yeah, that's such an awesome question. I would say be patient. And that sounds obvious, but it's not. There's far too many people that get a little bit of money or get an itch to buy something, and they rush into it much too quickly. I would much rather have somebody go and spend the time in anything. It can be buying a stock, it can be buying jewelry, it could be buying crypto, it could be buying real estate. I think the most prudent thing someone can do is commit to becoming an expert in that. So fully understand exactly what it is that you're buying, fully understand the market, so you're in tune with everything that's happening, so that you can call yourself a de facto expert in the space. And I think if you give yourself that runway to being an expert in the space, you have the best chance of making an educated and wise decision. And I think if you shortcut that, that's when you're starting to open yourself up for unnecessary risks. So that's what I would say, is just be patient, commit to it. If you've got a long-term horizon, which I think anybody investing in real estate they should have a long-term horizon. Waiting an extra year is not a big thing in the grand scheme of your investing career. So commit to being patient.
Yeah, I like that. How about any book recommendations?
I read a lot of random books, actually. I just so happen to have one right on my desk called Metropolis. My camera might not focus there. History of the City. I like reading just random books. I do actually have one that I just read not too long ago, which I can enthusiastically recommend. It's called Endurance. And it's about an explorer named Ernest Shackleton. And he led a boat of 29 people, I believe, to be one of the first. I think that they were planning on being the first to cross the Antarctica. By then, it wasn't mapped out at all. They had no information, and they basically got trapped in ice, and they had to abandon their ship, basically survive for several months with the limited amount of supplies that they had on hand and make it back to do it. And it was a crazy rescue story, and how they had to get split up, and how people had to go in and take some death-defying endeavors to do it. And miraculously, all of them ended up surviving after being in the cold weather, in like the most bitter and inhospitable conditions you can imagine. They all survived, and it was a fascinating book. I probably read that book in 3 or 4 days.
Wow. Okay. Yeah, that's a good one. I know my dad had read that and kind of referred it to me. So, well, great.
It's very good.
Well, Chad, you've really opened my eyes to industrial, and I really appreciate it. I know you've added some value for our listeners, and thank you so much for spending a little bit of time with us here on the show.
Hey, thanks so much for having me on. I loved it. Great questions, great conversation. Thanks so much for having me as a guest.
All right. Thank you, Chad.
Being that you're still here, I trust you found value in this episode. I personally wish I would have known these guests and strategies when I started my wealth creation journey. Go to wealthflow.capital to subscribe to our newsletter. And as a free gift, we will send you our quarterly market report and the top 10 things to look for in an investment opportunity. Take a minute to give our show a rating and review. Help us reach 1 million professionals by subscribing and sharing this episode with someone you know who could also find value in it.